Capital collapse here. Silver just bounced 18% off the $71 low. We're sitting at $85 right now. And there's one level everyone needs to understand. The 150 exponential moving average on the hourly chart is at $96. That's $11 above where we are. If we break it and hold, the next target is 110. If we fail and reject, we're testing $80 or lower. This isn't speculation. This is the technical level that matters right now. In yesterday's video, I walked through the bearish scenario, how the 150 EMA had flipped from support to resistance, how we got rejected at $90 and came back down. Some of you said I was being too bearish, but that's the level we were watching, and it played out. We hit resistance, got rejected, came back down. Now we're at a crossroads. Do we reclaim $96 and flip it back to support, or do we fail here and test lower? I don't know which one happens, but I can show you both scenarios with real data. No hype, no agenda, just what the chart is telling us right now. If this kind of analysis helps you plan instead of gamble, hit subscribe and drop a comment with Capital Collapse so I know the community is paying attention, because about 70% of you are long-term stackers. You're holding for years, maybe decades. The other 30% are traders trying to time entries and exits. This video serves both: the technical picture for short-term moves and the fundamental reality for long-term holders. Let me give you the current state of the market as I'm recording this. Silver, Western spot and futures, 85.12. Shanghai spot, 99 or 87. Shanghai futures, 134. Shanghai premium, $14.75. That's about 17.3% premium over Western prices. A few weeks ago, that premium was $41, the largest in recorded history. Now it's compressed to $14.75, still elevated, but nowhere near the extreme we saw at the peak of the crash. Here's the critical technical level, the 150 exponential moving average on the hourly chart. When we were above $100, that level was support. We tested it, bounced, tested it again, bounced. It held us up, but then we broke below it. And when support breaks, it becomes resistance. That's a bearish flip. The 150 EMA is now at $96. We're at $85. We need to reclaim $96 and close above it on the hourly chart to confirm the flip back to support. If we do that, bulls are back in control. If we fail, bears stay in control. Now let me walk you through the technical picture in detail. After the crash from $121 to $71, we've bounced 18%. That's a significant move. But is it the start of a new rally or a dead cat bounce before lower lows? The answer depends on what happens at 96. Let's talk about volume. Volume on the bounce from $71 to $85 has been decent, but not spectacular. We're not seeing the kind of explosive buying that confirms a bottom. What we're seeing is short covering and some bargain hunting. That's not the same as a sustained rally driven by new buyers stepping in. If volume doesn't pick up as we approach $96, that's a warning. Low volume rallies fail at resistance. Now let's look at the RSI. The relative strength index on the hourly chart is at 52. That's neutral, not overbought, not oversold. In a strong uptrend, RSI stays above 50. In a downtrend, it stays below 50. Right now, we're right at the line. If we break above $96 and RSI breaks above 60, that's a bullish signal. If we fail at $96 and RSI drops back below 45, that's bearish. MACD on the hourly is showing a bullish crossover. The MACD line crossed above the signal line. That's a buy signal in theory, but here's the problem. We're still below the zero line. MACD crossovers below the zero line are weaker than crossovers above it. So this is a bullish signal in a bearish structure. It's saying we might bounce, but we're not in a confirmed uptrend yet. For MACD to confirm a full reversal, we need to see it cross above the zero line. That happens when momentum shifts from negative to positive. We're not there yet. Let's look at both sides. Because the market doesn't care about what we want to happen. It cares about what the data says. So let's start with the bearish case. Bearish case first. Number one, the 150 EMA at $96 is now resistance. We broke below it during the crash. When support becomes resistance, that's a bearish flip. We tested $90 earlier this week and got rejected. That rejection tells you there are sellers waiting above current levels. Bulls tried to push, couldn't hold, got pushed back. That's a warning. Number two, Bitcoin is below $74,000. That's the lowest level since April 2025. Bitcoin often leads risk assets. When Bitcoin breaks down, everything else follows. Silver is considered a risk asset in the short term. If Bitcoin keeps falling, silver is likely to follow. And Bitcoin is sitting right at a major support level. If $74,000 breaks, the next stop is $68,000. That would drag silver down with it. Number 3, bond yields are spiking globally. The U.S. 10-year Treasury yield is approaching the highest level since August 2025. German 30-year bond yields are at the highest level since 2011. Japanese 10-year yields are near the highest since 1999. When bond yields spike, it's a sign of systemic stress. Central banks are losing control of the bond market. When that happens, everything sells initially. Stocks, commodities, metals. Cash becomes king. Only after the dust settles does the safe haven bid come back to gold and silver. So rising yields could mean more short-term pain before the rally resumes. Number 4, geopolitical risk is escalating, but not helping metals yet. Reports of the U.S. at war with Iran are breaking headlines. If true, that's a major catalyst. But the initial reaction to war is often risk-off across the board. Sell everything, raise cash, wait for clarity. Only after the situation stabilizes does gold and silver get the sustained safe haven bid. So if the war escalates, we could see more volatility and downside before the rally kicks in. Don't assume war automatically means higher gold and silver prices immediately. History shows the opposite. The first move is often down. Number 5, we're in a downtrend on the daily chart. Lower highs, lower lows. The structure is bearish. We peaked at $121. Then we made a lower high at $110. Then we crashed to $71. Now we're bouncing to $85. But until we take out $110 and make a higher high, the downtrend is intact. And downtrends don't reverse at the first bounce. They fake you out with dead cat bounces that fail at resistance. This could be one of those. That's the bearish case. The 150 EMA at $96 is resistance. We got rejected at $90. Bitcoin is breaking down. Bond yields spiking. Geopolitical chaos hasn't helped yet, and the daily chart structure is still bearish. If we fail to reclaim $96, the next test is $80. And if $80 breaks, we're retesting $71 or going lower. But here's the bullish case, and this is where it gets interesting, because the physical market is telling a completely different story than the paper market. Bullish case. Number 1, physical silver is still near impossible to source. Yes, the Shanghai premium compressed from $41 to $14.75, but that's still 17% above Western prices. In a normal market, premiums are 1% to 3%. We're at 17%. That's not normal. That's stress. Mints are still closed or on allocation. Refineries are still backlogged. Dealers are still struggling to get inventory. If you call a bullion dealer right now and try to buy 1,000 ounces at spot, good luck. You'll pay $8 to $10 over spot if they even have it. The paper market shows $85, but the physical market is trading at $93 to $95. That disconnect matters. Number 2, COMEX open interest is at multi-month lows. As of Monday, silver open interest was at 142,368 contracts. That's the lowest since May 2025. Open interest at multi-month lows signals that the forced liquidation is done. The weak hands have been flushed out. The leveraged longs have been liquidated. When open interest craters like this, bottoms form. Not always immediately, but the selling pressure is exhausted, and when selling pressure exhausts, buyers step in. Number 3, central banks are still buying gold aggressively. In the most recent quarter, central banks bought 328 tons of gold. That's just below the record 345 tons bought in the previous quarter. Poland bought 102 tons. Kazakhstan bought 57 tons. Central banks have been net buyers for 33 consecutive months, 33 straight months. They're not stopping, they're not slowing down, they're accumulating regardless of price. And when central banks buy gold, silver follows. The two move together over time. Central bank demand for gold is a tailwind for silver. Number 4, sentiment is washed out. Everyone is bearish. Retail traders are calling for $50 silver. Analysts are saying the bull market is over. Social media is full of panic. When everyone is bearish, that's usually a bottom signal. Markets don't bottom when people are optimistic. They bottom when people give up. And right now, people have given up. That's contrarian bullish. Number 5, historical volatility in precious metals bull markets. During Germany's hyperinflation from 1914 to 1923, gold went up 1 billion times. But monthly volatility ranged from 30% to plus 160%. Even with perfect foresight, holders experienced gut-wrenching swings. This is normal in precious metals bull markets during currency crises. The volatility we're seeing now, a 40% crash followed by an 18% bounce, that's not unusual. It's part of the process. The fundamentals haven't changed. Debt is still exploding. Currencies are still being debased. Industrial demand for silver is still growing. Solar, EVs, electronics all require silver. The bull thesis is intact. The volatility is just noise. That's the bullish case. Physical market still tight. COMEX open interest washed out. Central banks buying 33 straight months. Sentiment bearish. Historical volatility is normal for this kind of bull market. The fundamentals say this is a buying opportunity, not the end. So where does that leave us? We're at 85s. The 150 EMA is at $96. That's the line in the sand. If we reclaim $96 and hold above it, bulls take control. The next target is $100, then $110. If we fail at $96 and get rejected again, bears stay in control. The next test is $80, and if $80 breaks, we're retesting $71 or going lower to 65s. Here's what I'm watching. Number one, can we close above $90 on the hourly chart and hold it? That's the first step. We tested $90 and failed. We need to reclaim it and use it as support. If we can hold $90 for a few hours, that sets us up to test $96. If we can't hold $90, we're probably going back to $82 or lower. Number two, volume. If we approach $96 and volume picks up, that's bullish. It means buyers are stepping in at resistance. If volume is weak as we approach $96, that's bearish. It means there's no conviction behind the move. Low volume rallies fail. Number three, Bitcoin. If Bitcoin holds $74,000 and bounces, that's a tailwind for silver. If Bitcoin breaks $74,000 and heads to $68,000, that's a headwind. Watch Bitcoin. It leads. Number four, the Shanghai premium. If the premium starts widening again from $14.75 back toward $20 or $25, that's a signal that physical demand is accelerating. If the premium keeps compressing toward $10 or $8, that's a sign that physical demand is weakening. The premium tells you what's happening in the real market, not the paper market. Current state summary: silver at $85.12, Shanghai at $99.87, premium $14.75, about 17%. The 150 EMA is at 96. We're $11 below key resistance. We bounced 18% off the $71 low, but we haven't confirmed a reversal. The technical picture is mixed. Rejection at $90 is bearish. Open interest washout is bullish. The physical market says we're close to a bottom. The paper market says more volatility is possible. For long-term stackers, here's what matters. Can you source physical silver at reasonable premiums? If yes, and you're stacking for 5 to 10 years, this is a non-event. The daily chart, the hourly chart, the 150 EMA, none of it matters if your time frame is measured in years. Your thesis is currency debasement, industrial demand growth, and central bank accumulation. Those fundamentals haven't changed. So you stack, you hold, you ignore the noise. But if you're trading, if you're using leverage, if you're playing short-term swings, then every level matters. You need to know where support and resistance are. You need to know what happens if $96 breaks or fails. You need to manage risk, because leverage in a market this volatile can wipe you out before you have time to react. Here's what I'm not doing. I'm not calling a bottom. I'm not calling a top. I'm not saying buy here or sell here. What I'm doing is showing you the data and the levels. If we reclaim $96, here's what that means. If we fail at $96, here's what that means. You decide what makes sense for your situation. You decide your risk tolerance. You decide your time frame. This is war-driven, geopolitically chaotic, systemically unstable price action. Headlines can reverse in hours. What looks like a breakout today could be a bull trap tomorrow. What looks like a breakdown today could be a bear trap tomorrow. The only thing that's certain is uncertainty. So plan for both scenarios. Know what you'll do if we break 96. Know what you'll do if we fail at 96. Have a plan, not a guess. If you're finding value in this kind of breakdown, subscribe to Capital Collapse. I'm not here to hype. I'm here to analyze. Both sides. Real data. No agenda. Just what the market is showing us. Drop a comment and let me know. Do you think we break $96 or fail at 96? What are you watching? Do your own due diligence. Understand the risks. Trade with logic, not emotion. And remember, the 150 EMA at $96 is the level that matters right now. Everything else is just noise until we see what happens there. Capital Collapse out.